Good day to all. Today we're going to discuss another topic or chapter in auditing and assurance services, that is audit of the acquisition and payment cycle, talking about tests of control, substantive tests of transactions pertaining to accounts payable as well. Then this is focused on acquisition, so all transactions in which we acquire assets, and then payment for liabilities and expenses. First objective is to identify the accounts and the classes of transactions in the acquisition and payment cycle. If you can recall, when we discussed actually about the previous two topics pertaining to sales and accounts receivable, so we looked into the accounts that are affected and the classes of transactions as well. And this is similar to acquisition and payment cycle. So we can see here that there are three classes of transactions. As what we've said a while ago, acquisitions of goods and services, so products as we speak of, assets actually which are being acquired, but they're not just the tangible but also the intangible, because we have the services. But these services would result, of course, to expenses, because we cannot, for example, receive services and then we are going to consider that as assets. Example would be, let's just say, the services provided by the lawyers, so legal fees, expenses, and also the services provided by, let's say, workers or employees. So these would be in the form of salaries, expenses, because they will benefit in just one accounting period or not more than one accounting period, whether that's a month, a quarter, a semester, or a year. Then cash disbursements, of course, disbursements would be another term for payments. Then number three would be when we purchase or acquire or buy goods and services. Then for goods specifically, it's possible that there would be returns and allowances, actual goods returned to the seller or vendor because of certain defects and issues about the product, and then the discounts which shall be deducted. Next, these are the accounts in the acquisition and payment cycle which are affected. If you can notice, majority of the accounts are actually relatable, most especially with cash and bank, because it is through here that we actually pay the transactions, hence the most liquid asset, because it is actually the busiest also, in that it is to be used in the payment of certain expenses or liabilities. And that's why we can notice here on the accounts payable, when we pay, that's on the debit side. Then on accounts payable debit side, we have the returns and allowances and the discounts, because these are deductions also coming from these two accounts. Then normal balances of these two accounts would be credit, and then opposite would be debit on the accounts payable. So think of two sides or opposites or dual effects or systems in accounting. Then for accounts payable, when we acquire goods and services, so that would be a credit. This is the normal balance of accounts payable, and a corresponding debit on the purchases. Also, when we acquire PPE and asset, debit, credit here, prepaid expenses, debit, all expenses would be on the debit side. So we can notice here administrative expenses, all expenses related to administration as opposed to selling expenses, which are connected to sales. And of course, the manufacturing expenses would be the overhead related to manufacturing processes or production process or processes. And then these costs, by the way, will be added to the cost of the product. So product costs, while selling and administrative expenses are period costs which shall be expensed immediately. All right, so these are the most common accounts that are affected in the acquisition and payment cycle. Next, for second objective, describe the business functions and the related documents and records in the acquisition and payment cycle. So let's look into each. We have various acquisitions that we can do. So assets, inventory, PPE, leasehold improvements. By the way, when we rent a certain space or building, for example, or house and lot in which we actually made some improvements, so we call these additional modifications which would, let's just say, improve the said property, plant, and equipment as leasehold improvements. Leasehold without improvements would be the right to use the asset or use of rights under the law. But with the word improvements, such would become assets. And then we also have expenses. We have manufacturing expenses and selling administrative expenses. Then assets also prepaid expenses, short-term or current, and liabilities. So basically the acquisitions would involve assets, liabilities, and expenses. Then cash disbursements would be the payments of the said assets, liabilities, and expenses. Then the connection of accounts payable, of course, would be that or any other liability in that such would be decreased because of the payments. Then purchase discounts would be certain deductions of our purchases because when we pay now the accounts payable related to the purchases, this would decrease such. Then business functions in the cycle. So normally we begin with the order just like the sales. We process the orders, then the purchase orders will be sent to our vendors and suppliers and such will deliver the goods to us and we receive the goods and services in good condition. So we sign now the delivery receipt, we have the receiving report, then we will now record the liability once our vendor or customer will be sending the sales invoice together with the billing statement or with the statement of account. Then the liability will be processed and will be recorded and disbursed accordingly. So this would be the four areas in which the said process involving this particular cycle, the acquisition and payment would be involved. Then what are the related documents and reports? So we have the purchase orders related to processing. So any order of goods would begin with the requisition or the request. So this purchase requisition form would be the evidence that the certain user or department or user department is in need of such particular assets with authorization and approval before making the order. This requisition slip will be attached to the purchase order. Then purchase order again will be sent, communicated to the vendor or supplier, and then receive the goods and services. Thus, we have the receiving report. If the seller has the delivery receipt, we have the receiving report on our end as buyers. So in the sales and collection cycle, we are there on the part of the vendor or supplier or seller. Now we are on the part of the buyer of the goods and services. Then in recognition of the liability, we have the sales invoice received from our vendor or supplier, and on our end, as the buyer, we have the vendor's invoice or the purchase invoice. Debit memo, on another hand, is the evidence for the returns, purchase returns, and allowances. The voucher is for the payment, and then the transaction file will be the summary of all acquisitions made during the period. So if you are using the voucher system we're in, all payments, we are going to make use of the voucher or the vouchers. By the way, the voucher register would be, or the transaction file, of course, would be summarizing all acquisitions, all payments involving the voucher, whether that's a liability, that is an expense, or what. Because if you are using or we utilize the special journal, so if we are using voucher system, that would have impact later on for the payments because the voucher system would be the payment of all liabilities and expenses. So in that case, that would be the so-called check register. If we are utilizing, for example, the voucher system, but for non-voucher, normally this is called as the cash disbursements journal. Okay, so to continue recognizing the liability, we have the acquisitions journal or listing. So all of the transactions involving in the acquisitions, again, payments, expenses, liabilities, and assets, goods or services. Then the accounts payable master file, the record of all accounts payable made, the trial balance, so the balance of accounts payable, and the vendor statement, so the sales invoice sent to us, and the billing statement. Then we have here the processing and recording of cash disbursements. We have the check for payment. Then normally that is like removed from the check file that we have, or the check book, and then that will be sent to our vendors or suppliers, or let's just say whoever is providing the services to us. Then cash disbursements transaction file would be showing all the cash disbursements made, so all the source documents and all the attachments there are. Then we also have the journal or the listing of such cash disbursements. Okay, number three, we have to understand internal control and design and perform tests of controls. And then the STT or STOT, Substantive Tests of Transactions for the acquisition and payment cycle. We have to understand that internal control again refers to all processes, procedures, steps, conventions, rules, frameworks that are intended to achieve certain objectives under the COSO framework, the Committee of Sponsoring Organizations of the Tradeway Commission. So we have A, fairness and reliability of financial reporting. B, effectiveness and efficiency of operations. C, compliance with applicable laws and regulations. And D, safeguarding of assets. Some books would not have letter D, but then others would include letter D. Okay, tests of controls would be testing those particular internal controls present, while STOT would now be on the transactions. But we focus on the AP cycle, acquisition and payment cycle. Then we have a review of this one, the methodology for designing controls and substantive tests. First, we have to obtain understanding of internal controls involved in the acquisitions and cash disbursements. Then we assess the planned control risk. So how risky the company is in terms of failure of the internal controls present related to acquisitions and cash disbursements existing or present of the business. Then we determine the extent of testing the controls. So when we say extent, is it, let's just say, less extensive or more extensive? Of course, the ruling is that if it is riskier, then we perform more tests. This is, of course, provided that the given internal controls of the company are at least effective and efficient, because if they are not, we are not going to perform the test of controls because we are just wasting our time. If we have already obtained the knowledge that even with limited tests, that the internal controls present are ineffective and inefficient, so we remove or we do not perform the next set of controls testing or tests of controls, and therefore we have to increase our other procedures, especially the substantive tests of transactions, to satisfy ourselves with the procedures or with the evidences that we will gather to support our opinion or conclusion later on. Then the TOC or test of controls and the STOT, of course, will be designed with respect to or would involve the audit procedures, the sample size. So, of course, if there are more risks involved, or the riskier the controls, or let's just say the happenings or the transactions in the company there are with respect to the controls present. So we perform more audit procedures, bigger sample sizes, and we have to select more items, and the timing should be as much as possible closer to the end of the reporting period or accounting period, so that we will be able to achieve next or close to the balance or ending balance at the end of the accounting period. Since accounts payable and the payments involved, the payables and the payments or disbursements actually are items that are really moving, or they are actually plenty of them, and they can occur anytime during the accounting period or all throughout. So that's why we have to perform closer to the end of the accounting period. Then there is a note here that extent of testing of controls is determined by planned reliance on controls. Yeah, so as what I've said, if we would be relying much on the controls, so meaning to say we have to do extensive or more extensive testing. Then for accelerated filer public companies, so these are the big companies in the US, then testing must be sufficient to issue an opinion on internal control over financial reporting. The question is why? Because these accelerated filer public companies under the PCAOB, which is an arm of Securities and Exchange Commission in US, PCAOB stands for the Public Company Accounting Oversight Board, in which the audit on internal control over financial reporting is a requirement in addition to the audit of historical financial statements. Okay, so we have to understand internal control as well. We have to study the client's flow charts, then the questionnaires, and we do walkthrough tests. So we really have to check their processes by doing our own reperformances. We also have to assess the planned control risk in that the internal controls present cannot detect material misstatements. So authorization, these are now our incompatible tasks, duties, and responsibilities. Authorization of purchases, then the custody of the asset should be separated from the other functions, namely the C, R, and E. We have the custody, authorization. A, of course, is authorization here. Then R is recording and execution. So C, of course, must be separated from A, R, and E. Then we ensure that there is timely recording and independent review of transactions. So if somebody processes such, somebody also reviews the processes. And then authorization of payments. Before any payment should be made, there must be proper authorization coming from authorized parties. Then we determine extent of testing of controls. As said, the auditor would identify the key internal controls and weaknesses, and then by then we would be able to assess the control risk there is in the company. Then tests of controls are to be performed so that the auditor can obtain evidence that controls are operating effectively and efficiently. Then here are controls and substantive tests of transactions for acquisitions with respect to management assertions like occurrence, completeness, and accuracy. So in occurrence, we have to make sure that the recorded transactions actually existed because they are related to the goods and services received. While all acquisitions or transactions that existed should be recorded, that's completeness. And the amount should be accurate, or the values presented on the financial statements and disclosed in the notes should be accurate. Also, they should be properly included, posted in the ledger, and summarized on trial balance all throughout the accounting process. Classification in terms of the accounting elements and whether they are short-term or long-term or current or non-current. Then they should be recorded on the correct dates because this can be an avenue for window dressing just to improve the financial position, performance, and cash flows. So certain transactions are recorded, for example, for this year to the next or to the next or of the next to the previous or current accounting period. Then attribute sampling would be the sampling based on the characteristics of the population. So we focus on the qualitative characteristics, not on the quantitative or financial amounts. And this is a common practice in this area, especially for acquisitions and payments. Then the differences of APC transactions compared to others. As what I've said, there are larger number of them. Then this requires significant judgment because of the number, which is large, and normally the amounts also will be wide. By the way, I said a while ago that attribute sampling is common, but it doesn't mean that we cannot do also the other one, which is variable sampling, in that it is focused also on the values. Next, number 4, describe the methodology for designing the test of details now. So we look into the details of the balances at the end of the accounting period for accounts payable using the audit risk model. Okay, so methodology would be We have to identify the client business risks. There are certain businesses which are riskier compared to the others, as well as this account could be riskier than the others for possible understatement. Because for liabilities, normally they're understated so that the expenses would be lower and the equity would be higher, as well as the assets, to improve financial performance and position respectively. Then performance materiality is, of course, on the set materiality level, or the level in which we can tolerate or accept that any amount below to that would be considered immaterial, and equal to that and above would be material. So such would be our focus for material amounts. Then inherent risk, the accounts payable normally could be riskier for misstatement. Then that's phase one also. Then control risk should be assessed. After that, in phase two, we now go to TOC and STOT. For phase three, we design analytical procedures, which are the ratios for accounts payable balance. Then we now design tests of details of accounts payable balances with respect to audit procedure, sample size, items to select, and timing, which are already discussed a while ago, that of course the riskier the accounts are, so more extensive audit procedures, greater sample sizes, more items to be selected, and closer at the end of the accounting period. Next, what about for analytical procedures or the financial statement ratios for AP? So we will be doing these procedures for possible misstatement to occur. Example, we compare acquisition-related expense account balances with prior years to check if the figures really are dramatically moving. For sure, there would be ranges within the industry-related clients or companies. And what would be the possible misstatement? Misstatement of accounts payable and expenses. That's what we would target. Then what about review list of accounts payable for unusual, non-vendor, and interest-bearing payables? So there are liabilities actually like accounts payable, just providing the oral or verbal promises to pay for payables which are not usual, so not done on the trade, then not involving with a vendor or any vendor, and they're interest bearing. So what could be the misstatement, classification misstatement for non-trade liabilities? Because accounts payable normally are for the trade, meaning related to buying and selling activities, but of course on the part of buying. Then compare individual accounts payable with previous years. So we have to check if our accounts payable percentages with our clients are within the ranges, or with our judgment, considerable judgment, that they are actually within, let's just say, a determined range. So we would be seeing that there can be possibilities of unrecorded or non-existent accounts. So they are just being either unrecorded understatement of such, or the accounts really are not existing. So intentionally adding more liabilities and more vendors or misstatements, of course. Next, what about calculate ratios such as purchases divided by accounts payable and accounts payable divided by current liabilities? So if we have these ratios, we'll be comparing them with the industry-related ratios, and we will be seeing, same to the previous one, unrecorded or non-existent accounts. Okay, then we design and perform tests of details of balances. Again, the balances should be checked in terms of how such are obtained. Then for AP or accounts payable, including out of period liability tests. So here are our out of period liability tests, namely examine underlying documentation for subsequent cash disbursements. So we have to check the subsequent cash disbursements, like if this is the end of the year or accounting period for annual financial statements purposes, so December, and then January of next year, there are subsequent cash disbursements made. So it's possible that to improve, for example, the financial position, the cash disbursements supposedly that are to be paid for liabilities existing or to be paid by December are just reported next year. So it's possible that these liabilities actually were not reported and then were just recognized the next year then. Even that's another situation, but closely connected. So you have to check cash disbursements which are made subsequent or close to the end of the reporting period of the next year. Then what about for bills not paid several weeks after the year end? As what I've said, we examine also the source documents, the attachments, and all. Then receiving reports for the goods and services received issued before year end. So meaning we already received the goods and then are they really recorded as liabilities? Because the vendor's invoices or purchase invoices for our case and the sales invoices of vendors will be our source documents basis for recording of liabilities. Then also we trace vendor statements that show a balance due to the accounts payable trial balance. So the trial balance actually for AP would be the schedule of accounts payable, but overall amount will be forwarded to the trial balance for the company as a whole. Going back, so we trace the vendor statements that has the balance, and then for every vendor, there's a balance to the schedule and to the overall, especially also with the general ledger. So all should be equal. So vendor statements, the subsidiary ledgers, then the total of all the vendors master file, then the general ledger, the trial balance for the schedule of AP, and the overall company trial balance for the total amount. It's also possible that we send confirmations, whether positive or negative, to vendors with whom the client does business. But because there are plenty of transactions for accounts payable and disbursements, it's really possible that we will be doing positive confirmation still, despite that fact, because the amounts are bigger. But if like fewer and then let's just say bigger, positive, if ever let's just say more in number, but then the figures are lower, so we do negative confirmation, as discussed in the previous two chapters. Then cutoff tests, most especially for the end of the reporting period as to who owns the goods or inventory in transit. So when we say in transit, meaning the goods are still on board by ships or trucks or airplanes, whatever the means of transportation or delivery there would be, and then not reaching yet the destination or the customer or client or us. So in that case, we have to check the terms for the free onboard terms, whether destination or origin. If you say destination, so at the point of destination, that's the time that there would be transfer of ownership of goods. So the destination is the buyer's premises. So in that case, if still in transit, the seller owns the goods. It's just a review. If FOB, origin, or shipping point, so at shipping point, the seller releases the ownership of the goods. So at that point, the buyer becomes the owner. Okay. Number 7, we have to distinguish the reliability of vendors' invoices, vendor statements, and confirmations of accounts payable as audit evidence. We have to make sure that the vendors' invoices and all the documents here are reliable, meaning they are done, of course, by authorized parties. Then we have to make sure that there would be segregation of incompatible tasks, duties, and responsibilities to prevent fraud as much as possible, even the errors which are material to occur. And then confirmations as being used to gather or as audit evidences. So we have to distinguish between vendors' invoices, the sales invoices, and the billing statements, which would contain the billing statement would be the amounts to be paid, while invoices would be the details of the goods and services acquired by the company, including the number of units, the unit cost, and the total costs. Then also the vendor statements, as said, between the confirmations, which are ways of telling and confirming or verifying that these balances really are correct through sending these confirmation forms or letters or slips to the vendors. So here's an example of an AP confirmation. So it is said here that the company, which is stated here, Jones Sales Incorporated, this is our company or business, and then the head of the organization, of course, is Phil Geruvini, the president. So this letter is sent by him. Then that is sent to the vendor or seller, which is Jones Sales Incorporated, just to be able to get these information in the body of the letter. So I repeat, this is the president or CEO or the head of the buyer's end, and this is the head of the vendor's end. Then this letter is confirming of the following items because the company headed by Phil or Mr. Giovini is audited. So the auditors would be part of Murray and Rogers CPAs, and then they're conducting an audit of financial statements. They would like to know these following items, which are potential sources for accounts payable: the itemized statements or vendor statements, complete list of any notes and acceptances payable, because these notes could, of course, be part, especially if they're interest bearing, but of course, part of notes payable. Then itemized list of your merchandise consigned to us. So as consignees, we would be checking if ever there are still remaining number of items which are unsold, because these has to be reported to the vendor or consignor or original owner, since these goods should not be part of our liabilities anyway and part of our inventories as discussed in consignment sales. Then sample sizes also are very important. As said, the riskier the situation would be, the more items would be verified. Statistical sampling is less commonly used for the audit of accounts payable than for accounts receivable, wherein we are going to use statistics just to get or obtain the sample. So we can just use here other methods for sampling. Okay, then here are the types of audit tests for the acquisition and payment cycle. For cash and bank and accounts payable with respect to payments, we can do test of control, substantive test of transactions, and accounts payable, as well as for the expenses, connected also with accounts payable and acquisition expenses. But for the ending balances of AP and acquisition expenses, we can do analytical procedures and test of details and balances. And then if we are going to combine the four, such would result to sufficient appropriate evidence. So evidence which would be in terms of quantity, then also with the quality, so that the evidence would be convincing or persuasive. So persuasiveness of evidence is tantamount to sufficiency and appropriateness or quantity and quality of evidences gathered. Thank you very much for listening. This is it. And thank you very much, and God bless us all.